Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. 30-year fix is sitting at 6.89, which is up a little bit from last week's 6.86. Now, it might look like the 30-year rate is climbing up and interest rates are climbing up. Don't get me wrong, interest rates are elevated, but we're really seeing that they're staying within a range. We're going to take a look at that on the charts and see what may be impacting that. Without further ado, let's get over to the charts. 10-year. So we can see, like I said in the intro, the rates are creeping up, but we're kind of in this range right now where I don't think it's too serious. This is daily, kind of looking at the daily ranges of where the 10-year has been sitting. And to me, it doesn't seem like it's really too much cause for concern. The 30-year is ticking up slightly, but when we look back here at the end of May, the 10-year was a good bit higher, almost, what is that, like 20-something basis points. So it was a good bit higher. We saw a real decline in the bond market, which is this blue line right here. So it looks to me like we're in a range where it's not too scary right now, right? We're not back here like in January where rates were fairly high, probably in the 7s, but they're creeping up a little bit, but it seems to me like there is room for them to come down. Even if we look, this slight little incline is people buying into the bond market, and when people buy into the bond market, of course, the 10-year comes down. All right, so it's something to definitely keep an eye on, but it's not, oh my gosh, the world's over. The interest rates are the highest they've ever been. I saw a post on, I want to say Facebook the other day, and I want to say it was like when the rates were probably like over here, or maybe over here, but someone mentioned that the 30, they didn't even say what kind of rate. They just said interest rates, right? And I mean, talk about giving no context, but they just said rates are at 7.5%, the highest they've been this century, which to me, it's just absolutely ridiculous. It really is. I guess fear mongering is a good way to put it, but it's just so incredibly misinformed. Perhaps there were rates somewhere, maybe at a bank, because banks tend to have higher interest rates. I don't doubt that there could have been a 7.5, but that's just not the average, right? And we don't want to look at isolated incidences of these things. We want to look at what's going on with the average 30-year fix, and that's kind of what we gauge for mortgage interest rates. But they said it's the highest that it's been this century. Well, we're 25 years in. That's ridiculous. So, that's all just to say, really be careful of some of the things that people are claiming out there. Here on this program, what we want to do is be data driven, right? We want to look at the numbers and see what's actually going on. We don't want to just be fearful just to be fearful, but we also don't want to be turning a blind eye when things are getting too crazy. But to me, things are not getting too crazy. This was too crazy. This was pretty high back in January, so that was getting a little rough, but we certainly are not there right now. Okay. Now getting over to the economic calendar. Let's see. I think that where we left off, I want to say I had recorded last week's around Wednesday or so. So last week on Thursday, we had unemployment claims. Those are ticking up to 40 from, is this weekly? Yeah, weekly. From last week's 226. So unemployment claims ticking up and, higher than the forecast. So not great. Pending home sales. This is rough. This is month over month. They were just down. The number of homes under contract, and this excludes new construction. They were down 6.3%. So, this is, I'm sure, taking the average, which It's definitely going to depend on your market, right? We're recording this in Florida. The Florida market is probably very different than the Louisiana market. The even something like Jacksonville, Florida, is going to be different than like Miami, Florida, or maybe different than New England. So that's something to keep in mind, but not great looking at these numbers right here. Good news though with the PCE, which is the personal consumer expenditure. I believe that's what that stands for. But essentially what this is a measure of inflation that the feds like to use. That was only at 0.1% for the core month over month, which core just excludes food and energy as they are volatile. So only up 0.1%. Previously, it was 0.1% too, so this is good. Definitely good information. Personal income looks like that was up 0.8%. And that is the change in total value of income received by consumers. And spending was down. So income up, spending down. So income up is good. Spending down, not the best, but I don't know if that's anything particularly to be worried about. When we look at this week, we had JOLTS job openings. I'm recording this on Tuesday, so this already came out. And this is really the job openings. And it came out for the month. Yeah, excluding farming. So that's good. More jobs are open and available. So those people that are unemployed can find employment. This is a little interesting. Factory orders are down. So manufacturing side of things, it looks like maybe manufacturing's not doing too hot. Later on in this week, we have the unemployment claims. That'll be interesting to look at. And we have average hourly earnings, the non-farm employment change, and the unemployment rate. So all things that we're going to want to keep our eye on as we move forward in the week and see how that may impact the interest rates. Really what we want to see when we look at interest rates, it doesn't always have to happen this way, but oftentimes when the stock market is doing really well, the bond market takes a bit of a hit and vice versa. It doesn't have to happen that time. There's definitely been times where both are taking a hit, particularly when the confidence in the U.S. markets are dwindling. You will see the U.S. stock market and the U.S. bond market both take a hit, which we saw that just a couple weeks ago with the downgrade in the U.S. credits rating. It was a AAA. I think Moody's was the last one to downgrade it to a AA+, but seemed to not be too big of a deal. I believe people much smarter than me were saying that is a lagging indicator. So ended up not being too big of a deal. It didn't stick. Like I said, rates are up to 6.89, up from 6.86. Like I said, I don't think that's that big of a deal. In January, they were getting up to the 7s, and it does look like it's been climbing up. But when we look at the 10-year, it's nothing too scary. It's just something to keep an eye on. And we are going to go based off the data. We're not going to go based off of what random people are saying on Facebook. Alrighty. Well, that was it for this week. If you guys have any questions, if you have any home purchasing, any home loan questions, purchases, or refinances, give us a call at 877-TEAM-MBL, or you can find us at www.mortgagesbylinda.com. We have this little apply button or a contact button. We also have this little guy down here where you can have someone reach out to you. So let us know, and we hope you guys have a great week. Bye.